Hi, so my name is Dr. Adam Rabinowitz, and I'm an assistant professor, assistant professor and extension economist with Auburn University and ACES, the Alabama Cooperative Extension System. I'm new here to Alabama. I was hired and started work on July 1st of 2020 at Auburn University. Before this, I spent the last 4 years at the University of Georgia on the Tifton campus, working in peanuts and other row crops, so from the region and probably have met a number of you. For today to talk to you about peanut economics and some of the production and policy issues, which will be the focus of my work here in Alabama. So I'll go ahead and start just with a brief introduction of the items that I'll talk about today. I'll hit on a number of, like I said, production and related policy issues, input costs. I want to address a little bit of the 2021, what some of the expectations are. Talk about a little bit of budgeting and the cost comparisons, as well as potential returns that you might expect for peanuts and some other competing crops as well. Get into a little bit in terms of trade relations and some of the retaliatory tariffs that have impacted peanuts, as well as address a few policy issues today. I want to start by talking about interest rates, and we can see here on the left-hand side of this graph, this is the federal funds rate. Left-hand side of this graph, it shows that gray area, which is indicative of the great recessionary period around late 2007, 2008, and first part of 2009. And you saw interest rates drop pretty substantially down to near zero at that point, and stayed at that rate for quite a number of years. Started to increase in around 2016, steady increase as the economy kept expanding and growth occurred. On the right-hand side, though, we start to have another recessionary period. It's a little bit difficult to pick up here, but again, the shading that's there is our more recent recessionary period as a result of the pandemic. And that's that sharp decline here. But you'll notice a little bit of a decline even before the pandemic hit in terms of interest rates. And that was because of some of the trade issues that had occurring, trade tension, and also just a general slowing down of the global economy. But in particular, of course, as the pandemic hit in 2020, we see interest rates dropping down again to near zero, and expected to really stay there for the foreseeable future. A lot of that will depend on the recovery of the economy. But this is significant when we talk about lending opportunities with respect to capital purchases, land purchases, and also your operating notes as well. So the expectation is that we'll continue to see interest rates down very, very low. Diesel prices are another thing to kind of look at, because when we talk about the impact of the pandemic, this too had, we saw some significant declines in terms of where diesel prices were. The green line up here is what we're seeing here for the last few years in terms of diesel prices. And this drop that you see here is, again, as a result of the pandemic and just the change in terms of driving habits. The bottom line is the crude oil price, and so obviously the crude oil price driving in terms of what diesel prices do. So as the shutdown of many areas in the economy occurred as a result of the pandemic, we saw a lot less driving, less demand for oil and gas, and as a result, that sharp decline in terms of price. We do throughout 2020, started to see a little bit more of an increase, again, in the oil price that has subsequently shown an increase in terms of the diesel price. Some of that was a pullback in terms of production of oil, but it's not expected to have that price increase back to previous levels just yet. Again, a lot of that, though, is going to be fluid. Very much depends on how fast the economy recovers, and certainly how oil production continues to occur. There is expected to be, again, a little pullback in terms of production of oil. That'll help keep diesel prices at kind of the current levels of where they're at right now at the beginning of 2021. I wanted to spend a little bit of time now talking about some of the chemical input prices. And some of these inputs may not be specific to peanut production, but just in general gives you an idea of what's happening in terms of the chemical industry and some of the prices. And we'll just kind of go through a number of these, because there is a trend here that I just want to call attention to. You can see here, in terms of nitrogen prices, you see the peak around that 2012, 2013 area. in the last decade, and then a low point around 2018. We started to increase after that into 2019, but then as we got into 2020, this started to decrease again. We didn't quite hit that lowest point where we were in terms of 2020 as a decade low, but we are seeing a bit of an increase, and that is what is expected to happen. We see this increasing trend in the latter part of 2020 on a number of different chemical compositions. And so that's something to be aware of for 2021. We can look at here MAP and DAP prices. Again, looking at here, we've got the kind of that top line in kind of a bluish purple color there in 2019. You see that decline. And even though we're talking about down to very much historical low periods when we look at 2020, either in DAP or MAP, what you see here is towards the latter part of 2020, a very sharp increase in terms of what prices are for these products. And an increase that even goes beyond where it was in 2019, and as you see here, the red in 2021, continuing that upward trend, and very much above what that dotted line is, which the dashed line, that 5-year average price. And so that trend above kind of that 5-year average price, certainly not as high as where it has been in the past, but it's higher than where we've been in recent years and trending upwards. We see that on potash as well. Again, in the latter part of 2020, an increase in terms of price, and now 2021 price that again is moving up and is above that 5-year average. Same thing in terms of urea as well. So the reason why I kind of point out these is because I want you to think about a little bit what your production costs are, and in terms of that planning, looking at what your enterprise budgets are, and we do that as a university extension. We issue enterprise budgets every year, and you can go to the aces.edu website, search for enterprise budgets. The full link is there as well. And we've got peanut budgets for dryland and irrigated. And remember though, these are our kind of estimates as recommended management practices. They are also estimates in terms of kind of an average price that you might see. Actual costs are going to vary from farm to farm depending on your exact location, depending on the size of your operation, and depending on what some of your individual management practices are. So use these as a guide, use these as a starting point. They are customizable, and this is something that you can work with from there. And I'm going to talk about just a little bit of kind of what we're seeing when we put these enterprise budgets together, and you can do something similar for your operation as well, as looking at some of the net returns and doing a comparison for different crops. And so here I've got dryland crops, just a summary of what we would expect a yield to be. We're expecting 3,500 pounds per acre for peanuts. And the variable costs that we have built into that enterprise budget for peanuts is $567 per acre. So from that variable cost and that expected yield, we can figure out what that break-even price would be to cover those variable costs. And so you would need to get a $324 per ton price in order to cover all of your variable costs. Now keep in mind that means you're not covering at that price any fixed cost, any return on your operating, any return on your management time, any return on your capital, or return on your land either. So that is something that you need to consider as well, but at least in terms of what you should be producing this year, certainly covering that variable cost is what your goal is for current year production. So $324 a ton is what we're looking at as the break-even price at the variable costs based on what our enterprise budgets are. If we consider, and I say futures price there, but obviously for peanuts, no futures market, so a contract price, we're looking at contract prices that have started to come up a little bit and around $450 a ton. So if we assume that, based on that 3,500 pound per acre yield, then we'd be looking at a crop income for $788 an acre. So that would be $221 an acre above that variable cost. That would be your return to fixed costs, or your return to your operation or management. The other thing is we can now look at this with respect to what some of the other competing crops are for those same acres. And so with respect to corn, cotton, and soybeans, these are all based on the same enterprise budgets that we have for each of these crops on the ACES website. Where we look at, and again, all of these are dryland crops. And so you see again the expected yields for each of these variable costs, what those break-even prices would be. And then I also pulled futures prices from yesterday around harvest time price This is an example of what if you were to look at this based on that futures price, what current prices are for this year's harvest coming up in the latter part of 2021, that what your crop income would be then and how those net returns would ultimately compare to a peanut operation. And so you can see if we assume that contract price of $450 a ton for peanuts at the 3,500 pounds, based on our variable costs, we'd be looking at the peanuts net return above variable cost to be considerably higher than sort of those other options. So again, we see some opportunities there in terms of soybeans close to $200 per acre, and then corn and cotton, and this is even a cotton looking at 77.5 cents per pound, and even the soybean and corn prices considerably higher, much higher than where we were if we were talking about this a year ago. So this is one way to kind of look at this, and we can do the same thing from an irrigated crop perspective. Our enterprise budgets for irrigated crops looks at peanuts at expected yield of 5,000 pounds per acre and a variable cost of $711 per acre. That break-even price then would be $284 per ton, and if we assume again that same contract price and that crop income, we'd see on the irrigated crop a net return above variable cost, so that return to your fixed cost again, $414 per acre. As a comparison to some of the other crops grown in the region that you might be considering as well, again, we see where that peanuts does provide that higher net return. And again, this is even at futures market prices that are much higher than where prices have been in the past basically 5 or 6 years. So that is one thing to consider, where your net returns are, where your expected prices are, where your expected yields are, and really knowing your cost of production. And that's one of the big risk management strategies that I want to stress today is understanding what your cost of production is, because with that cost of production, you can then determine what your break-even price is. You can know then whether or not this is a price that's going to meet my variable costs or not. And you can then look at those forward contracts, those contracting opportunities, and really understand, okay, is this an opportunity that I'm going to be successful, or do I need to, maybe hold off a little bit, or where do I need to adjust sort of my portfolio of crops for the year? The other thing I also want to remind is evaluate crop insurance needs. February is the month to get signed up for crop insurance, and so make sure that you're looking at that not just from a standpoint of whether or not to opt for crop insurance, but what levels ultimately to buy into, and also being aware of some of the newer hurricane add-ons as well that can cover in case of the severe storms that we've seen here all too frequent in the region. I want to shift gears now to some of the trade issues that we've seen under the previous administration, presidential administration. We saw a number of trade renegotiations that were happening through the U.S. with a number of trade partners. And I wanted to call your attention to just a few of them, just to kind of recap and also think about where we're going moving forward. The Japan trade agreement was effective January 1st of 2020, and that provides an opportunity for peanuts where there were elimination of tariffs immediately and some additional tariffs on peanut products eliminating over the next 5 years or so. That opens up a lot of good trade opportunities for peanuts into the Japanese market. The other thing is China. We certainly know of the heated trade war that has been ongoing. That Phase 1 deal was signed the middle of January of 2020. That was a 2-year deal to increase agricultural exports from the U.S. to China. That is something that we need to really think about very carefully and look at where that's going to go, because there are a lot of tariffs that are still in place on both sides, both in China and the U.S. on a number of products. And of course, agriculture was the retaliation that China used to target against U.S. Tariffs against China products. But we did see, and I'll show in a little bit, a large increase again in terms of trade back to China from peanuts in 2020. The other thing is USMCA, the U.S.-Mexico-Canada agreement, that was effective July 1st of 2020, and that really was that renegotiation of NAFTA. Not any major changes really with respect to agriculture, but really just solidified peanuts' position in terms of trade with our nearest neighbors, and I'll show you in a minute why that is of utmost importance to the peanut industry. So if we look at peanut exports to the world, we can see here from 2010 to 2020, this last, on all of these slides here, 2020 is from January through November, so there might be a slight uptick in that once we get to the final year-end numbers of exports. But we see here where there were some peaks over these years, but generally kind of upward trend here in the last few years on peanuts, and that's certainly good, that there has been a market throughout the world for U.S. peanuts. As I mentioned, though, Canada and Mexico are the most important kind of trading partners because they are our nearest neighbors. It's easy to get access, and we have seen the largest number of exports consistently moving to both of these countries. So when we look at peanut exports to Canada, you see that continued growth over time. 2020 a little bit off of where 2019 was if we don't catch up in that last month of data there. But certainly an overall upward trend, and the same thing here in terms of Mexico. Again, 2020 pulling back a little bit on all of these. If we say 2020 pulls back a little bit, we also need to consider the fact that the pandemic has certainly created challenges, and even within the trading sector, created challenges moving products at times, especially early on when folks were just starting to figure out how exactly we could live in the current state and health crisis that we're in. Shifting over to the EU, this is one area that we need to pay attention to because the Netherlands has been one of our major trading partners with respect to the EU, and we are seeing new tariffs from the EU on peanut and peanut products from the U.S., and that is certainly going to pull down what has been, as you see, kind of somewhat volatile in terms of up and down movement, but has been a good, strong partner, though, for trade and destination for peanuts. And this raises a little bit of concern beyond just the 2020 numbers, because of the current tariffs staying in place. It is going to make it very difficult for peanuts to really be moving into the European Union market. That be Netherlands and Germany as well. Again, where we did see a little bit of drop-off there, as tariffs started to take effect, even on some of the peanut butter products going back into 2019. So that is something that we're going to have to look at for this year in 2021, is what that relationship will be between the U.S. and the European Union in terms of trade, and how that will continue to impact peanuts. But that is certainly a concern on the trade front for the industry. As I mentioned, the China Phase 1 agreement, we're now starting year 2 of that agreement, and you can see the effects of what I would say was a combination of things in 2020, the largest amount of peanut exports to China in any year. Before that, it was 2016. Again, we have to remember what kind of peanuts China is looking for. They typically want the lower priced peanuts because they're interested in the oil production. And so that farmer stock going directly into oil is really where their interest is, and so we saw that available here in the 2016 year. We had some of that in the 2020 year as well, plus I think the Phase 1 agreement was certainly a benefit as well to opening that door again to peanuts moving into the Chinese market. As I mentioned, that Phase 1 agreement, though, is really for 2 years of agricultural purchases, and so that's something that is going to have to still be worked on with the new administration now. Under the new president, we're going to have to see how those negotiations go. Those tariffs still exist on a lot of products, and we're going to the new administration is going to have to start negotiating some of these intellectual property issues and some of these other issues that really led to this trade war that's ongoing and continuing. From this, I just want to talk a little bit about where we've been with respect to net farm cash income and government payments, and how this then ties into some of the policy issues that are going to be at the forefront of any policy discussion moving into 2021 here. If we look at net farm cash income for Alabama here, we see this downward trend from a peak of 2014. Now, this does include more than just crops; it's also animal products as well. But in particular, what I'm highlighting here is that the difference between the blue and the green being the net cash farm income without government payments, and then the blue adding government payments, which you see here in some recent years being very high and starting to expand. And we've seen that even more. I don't show 2020 income here yet, but we've seen that in 2020 with the government assistance that's come from a number of different areas. In October, there were the payments in Alabama, we're talking about a little over $90 million based on PLC and ARC payments, all based on low commodity prices and the safety net that exists. And you see a number of products where, even corn was paying out on a PLC payment rate there of 14 cents a bushel on base acres. The other thing was the impact of the coronavirus and the Coronavirus Food Assistance Program, CFAP. And so here again, we saw a couple of different programs. The first program, while did not address peanuts, did make payments to cotton producers, corn as well. And so almost $95 million worth of payments there to Alabama producers, largest amount to those cattle producers. The CFAP2 program, also a little over $90 million. So again, all of these programs within 2020. Again, the largest amount of cattle producers, although here there are peanut producers as well that did receive that per acre payment based on their planted acres. And so, this is something that we've seen a lot of these payments, not just with respect to peanuts, but on all commodities in all of agriculture as a result of the impact from the pandemic. But this has raised a lot of questions just with respect to what is the role of government payments, and what are the role of these programs in particular, because these last two programs on the CFAP program, and if you recall even going back the last few years, the market facilitation programs, all of these have been ad hoc programs. Whether or not we continue to see those ad hoc type programs remain is going to be one of the things that's debated, or how that ultimately needs to factor in to the overall more permanent safety net programs, such as the Title I programs like PLC. So with that, kind of just a little bit of a reminder here with respect to PLC. This is the 2020 effective reference prices, and right now we are in the middle of the year of determining whether or not there will be any payments that will come in October of 2021 for that 2020 marketing year. Based on the 2020-2021 marketing year price projections, these green ones you can see are where payments would be in effect if the marketing year ended today. Prices, though, continue to move. We're starting to see prices that have increased for corn and soybeans and cotton as well. So we've started to see these projected payment rates decline. So right now these are what is projected. Again, if the marketing year ended today, there would be that payment on peanuts. I don't expect a big movement on the peanut side, mainly because this is based on pretty much going to end up being the older crop that's going to factor into this. But some of these others you might certainly see some shifts in terms of payments for this October. The other thing is to remember that you do have a decision that needs to be made before March 15th of 2021. That's something new. This annual election starts this year of enrollment for ARC or PLC. So for all the base acres that you have, making that decision between ARC and PLC for the 2021 crop year. And so you can see here what the effective reference prices will be. Excuse me. What the effective reference prices will be. These are the same as the reference prices have been. Recall just that ARC is that revenue program based on yield and price, where PLC is just that program based on price. So if the marketing year average price falls below this reference price, PLC would pay, whereas on the ARC program, it's very much dependent upon county yield and what that marketing year average price is. Just make sure that you make that decision by March 15th, 2021. Otherwise, there will be a default back to what you were enrolled in the previous year. Last bit of reminder on ARC PLC is just as you're looking at crop insurance again, this month being crop insurance sign-up time, just keep in mind that for supplemental coverage option, the SCO, if you do enroll in any PLC, those acres are still eligible for SCO, but if you enroll crops into ARC, those are not eligible anymore for planted acres on SCO. Just a sort of cotton note here with respect to stacks. If you have seed cotton acres and they are enrolled in ARC PLC, then those are ineligible for stacks on that planted cotton acres. It does not matter though for the other covered commodities. So if your peanuts are elected into PLC, that does not impact your stacks eligibility on cotton. So just a couple of reminders there. Last thing I want to leave you with today is just an outlook for 2021, some things to think about. There's a lot of uncertainty that's in agriculture, and that's not just this year, but certainly 2020 has been a crazy year for agriculture, and we've seen prices fluctuate widely. We've seen, as I showed you, even input prices starting to move, and some policy issues that need to be considered. That uncertainty is going to continue in 2021. We see the continued pandemic effects. Yes, the vaccine is starting to be rolled out, but it is predicted to be slow. We've got a new presidential administration. We've already seen in the first couple of weeks here a number of executive orders, changes in terms of policies, changes in terms of priorities, certainly thinking about some things around climate, water issues and other regulatory concerns. So, that is something to really kind of keep an eye on and be aware of where that impacts your agricultural production activities. Role of government payments and farm income as well is something that's going to be highly talked about. Whether it's directly for the peanut sector or other sectors, the fact of the matter is the Farm Bill is something that's going to come up with, does this provide an adequate safety net? And does it provide a safety net to the right sectors? And that means that questions around the baseline figures and expenditure in the Farm Bill is something that's going to be discussed, because whether that baseline is sufficient to cover all of the needs of the safety net program for all the different agricultural sectors, or if there needs to be additional income or additional expenditure, and that where that ultimately comes from. But the role of the fact that farm income is at a 6-year high right now because of government payments and these government programs, that is something that's being talked about and will be a policy issue that producers need to be aware of this year. Last thing, again, just from a risk management perspective, to know your production costs, consider your marketing opportunities and when the right time is for those, and be aware and engage in that policy discussion. So with that, I'll just leave you with my contact information. I'm happy to answer any questions that anybody might have. Feel free to reach out by email or give me a call. As I mentioned, I'm excited to be here at Auburn University and with ACES and in Alabama, and look forward to interacting with you in the future. Thank you.